they manufacture a house. Essentially, they are manufacturing a house for somebody else, or let's say large companies that build ships, or railway train engines, or aeroplanes. So these things are not manufactured on a production line. Okay, you don't have an assembly line in which you fix the doors, the wall, the vinyl, and the toilet, and the house is ready. No, you have to work on one house at a time, and then you go to the other house. So this kind of companies are called contractual companies. Same when they make aeroplanes or airline planes, they do it one by one. You have to work on one plane, finish that, and then move to the other plane. Whereas if you look at car production doesn't go on in a similar way. The goes through a assembly line. For example, the assembly line starts with the car chassis. That is the skeletal structure of the car. It will move further. Somebody will attach the engine and the transmission. It will move further on. Somebody will attach the body parts. That is the trunk, the bonnet of the car, the roof, the windows and doors. Then it will move forward. Somebody will paint the car. Then it will move forward. People attach the seats and the steering system to that. Then it moves forward. One person attaches the electronic system and wiring inside the car. Then it moves forward. There is the axle, then the tires. Then comes the coloring of the car, then the windows. And as it moves through a production line, at the final stage, the car is ready. So nobody was making one car at a time and then moved on to making a second car. No, the car was in a process and there were multiple cars made at the same time. So under cost accounting or generally under management, that is called a production based system. You have a production environment where something is produced on an assembly line. So they have a different cost structure because they have running cost, and they know how much input is going into one product. Same goes for your grocery and household manufacturing companies. Even for let's say like wheat or rice manufacturing, they would have the let's say like finger chips, or sorry, chips manufactured by Lay's or Miss Vicky's. So they will have the potato come in. Some they make the potato wet, they dip it in water, then they heat it. Then another machinery peels off the cover out of the potato. Then another machinery will slice it into thin pieces, and then another machinery will dip it into the oil and fry it. Then the other machinery will dry it. Then it goes into the packaging. So that's again assembly system. Whereas if you see for aeroplanes or train engines or houses, you make one thing from bottom to top. You manufacture it all. So when a plane is manufactured, they will start in a big hangar. Okay, like the company Boeing will have a big hangar. Inside it, they will start manufacturing the plane. They will bring the skeletal structure and start welding it. So they will weld the skeleton or the inside structure, the strong structure of the plane. They will weld it inside, attach everything. Then they will bring the covers of the plane. They attach that. Then they'll bring the windows. Then they'll bring the engines to attach to it. Then they'll bring the tires or the lift off system, and then they will bring the control system inside the plane where the pilot and the other person will sit. Then they'll start working on the interior. Then they will attach the seats for passengers, and after that maybe the toilet and other things. After that they are done. So they were working on one plane at a time, whereas car, they are working on multiple cars at a time. So one is called production system, the other is a contractual system. Okay, and the third one is the service based system, where you are not producing anything, you are providing a service to somebody, but still you're making money. You still have cost. It costs your business some money to provide that service, and the customers pay you, and you make money. So in that case, there's a different costing structure there. You do not have any input going in. The only input going in is some skill you perform with your hands, or some service you provide, or some work you do that helps somebody else. There is no product you're producing. So under that, costing becomes different. So on the surface level, these are the three kinds of cost structures we have. If the business has a production based system, does the business have a contractual system, contract based system, or do they have service based system of operation? Okay, so management accounting, or basically cost accounting, will analyze these three things differently, and it will give you analysis that based on this month, This is how much you spent on your production, and this is how much money you got. So that is cost accounting, and management accounting is a larger concept. Like it comes under uh, accounting. So let's say there is financial accounting that we saw before. In our last module, we saw financial accounting as to how accountant will record transactions and then post them into a ledger book, then move them from a ledger to a trial balance, and finally they will have the financial statements, that is the income statement and the balance are ready for. So that is accounting is different. You records recording costs. Okay, and management accounting is something that happens inside a company. Okay, it is not usually revealed outside what the cost or expenses of the company related to one product are. The company will release information as to this is what our whole cost structure was. This is the profit we made. This was our total expenses, let's say on salaries, wages, utilities. This is our cost of sales. This is our revenue. They will disclose that. But management accounting, many things are not disclosed. Like what is our per unit costs? Companies don't usually reveal that to outside people. Like just like we downloaded the financial statements for Apple, then I gave you assignment based on Amazon, JP Morgan, and third one was I think I don't remember what the third one was. So three companies, right? So if you go to the company's website, download their annual report, the annual report will only have financial accounting information. Okay, the information you will find is something you learned in financial accounting. It will not have anything related to management accounting. Maybe some percentages will be there, but most of the management accounting data will not be available anywhere to you. It is only available to the management inside the company. That is why it is called management accounting. That's what the management uses to make decisions about their production and service process. It is not revealed to people outside. Okay, so what you get to see normally from the statements is financial accounting data. So am I sharing the correct screen? Yeah. Management accounting. So introduction to management accounting. It works on processing financial and non-financial information. So it has non-financial information. What does that mean? Like when we were doing financial accounting, we were recording transactions, and our transactions were based on money. We just recorded the money, right? So if a person bought some goods, we wanted to know how much money worth of goods they bought. That's the only thing we recorded in our transactions. We didn't have any other information other than money, right? We don't record in accounting that I sold 2000 units of a particular product, or I sold 20 units, or maybe 200, any amount. We don't record how much of a product was sold. We just record in financial accounting that my transaction was worth $3,000. I sold goods worth $3,000. Whether I received the money or not received the money doesn't matter. But I sold goods worth $3,000. So financial accounting is based on financial information. Only money is recorded there. The difference is in management accounting is sometimes other things than money are also recorded. We have to record how many people are working on your production process. Okay, how many assembly lines do you have? If you have multiple assembly lines, then yeah, people working, how many assembly lines you have, and how many units you produced. That is a very important information in management accounting. So this is something we do not consider in financial accounting. We just look at how much the money was, and transactions are recorded with money only. So if I give you a transaction that does not mention the monetary amount, in financial accounting, you cannot make a journal entry, right? A journal entry has to be dependent on what the money transfer was, how much money exchanged hands. If you do not know how much the money involved in transaction was, financial accounting cannot record anything. whereas management accounting can do something about it. If you give information that our production was 3000 units in a month, that is very important information for management accounting. But for financial accounting, it doesn't mean anything. 3000 units we cannot record. The money spent on the 3000 units can be recorded. Okay, so the management accounting process is dependent on financial and non-financial information. Management accounting helps the management in strategic, operational, and control function. So strategic functions are very long-term plans. So companies do not have a plan to stay in business maybe for the next month or so. So they might have a plan to continue doing business for next maybe 25 years, maybe 30 years, could be 50 years. So let's take an example of strategic planning, like what they're doing in Calgary right now. So if somebody lives in Calgary, so they have this patch near the airport, where the airport of Calgary is. A lot of land surrounding the airport is empty on both sides, even on the eastern side and the western side of the city. They are empty. Western side, not that much, but on the east side, a lot of land is lying empty along a road that they call the Métis Trail here, or the 36th Street. So if you look at the land while driving, it will appear empty. But if you inquire if somebody owns the land, then you will find out that there are many companies who own that land. So there is Canadian Tire who owns the land piece already. There's Walmart who owns a piece of land. There may even be Costco over there that owns a piece of land. So these companies have already bought up pieces of land over there, but there's nothing there. It's just empty, barren land. And they may start working on that business in the next 5 to 7 years. And they have plans for this business for what they're going to do in the next 20 to 25 years. So that is called strategic plan, something that does not exist yet, but some businesses have already made plans about it. So that's a strategic plan for the company. Even if somebody tries to acquire a Tim Hortons franchise. So if you want to acquire a Tim Hortons franchise and you see a new plaza being built. So if there is a new plaza coming up, there is a new housing society, you go there and acquire. If the Tim Hortons franchise is available, no, they're going to tell you that it was sold away 3 years ago. 3 years ago, before even the construction of that housing project started, the franchises are already given away to people. So that's again a part of strategic plan. Somebody is going to open a Tim Hortons franchise at that housing area, but the housing area is not built yet. The area will be built in the next 3 to 4 years, and then they will start their franchise. Okay. So if you want to start a franchise, you have to approach or talk to somebody who's going to build a plaza in the next 3 to 4 years. So some barren land where a housing project will be starting in the next year or the next 2 years, maybe at that place, somebody can inquire about getting a Tim Hortons, maybe a McDonald's franchise or a KFC. They have to plan it way before the time, 3 to 4 years at least. And then you get it. So that is a strategic plan. So just like some people may think, like in Calgary, there is a Costco store that is outside the city. There is a mall, Cross Iron Mall, and there is a Costco over there, and there is another mall. Okay, so these are way out of the city. So it's like you leave Calgary, go for 3 kilometers, then the Costco and the Cross Iron Mall will arrive. Then you go another 3 kilometers, and the other town will arrive. So it is between two towns, and they still have business over there. But why are they outside the town? They think in the future the towns will be attached and there will be more population living over there, and they were able to acquire the land for a cheaper price right now, rather than acquiring land inside a city will be really expensive. So that's their strategic plan. So now we understand what strategic is. Then operational and control function helps with management in strategic, operational, and control functions. Operational is when your business is already running. Okay, you are already in the business, your production is going on, and you are operating it day to day. So that is the operational management. And then the control functions. Control functions are you look at the results of your business as to what is happening right now, and you change things. You try to tweak things here and there and improve your business. So control functions will mostly be like, as a member of the production department, you are informed that the cost of production this month was 88%. So depending on the selling price, your cost for producing a particular product was 88%, and the management wants it to come down to 85%. So then there are control functions that are performed. You change things everywhere, reduce the cost, and your control functions help you to reduce the price of that product. And companies will do crazy things to reduce the cost of their product. There are automobile companies who designed nuts and bolts for the car. So there are screws and nuts inside a car that are used to attach things to one another. So there are companies that even try to reduce the weight of that nut or bolt so that they don't have to pay a higher price for the metal they are buying. So for example, there is a head for the nut where you use that what do you call that clamp that you use to tighten the nut. Screwdriver is for screw, but if it's a bolt, there is a flat thing shaped like a spoon. So I don't know what it's called. But they changed the structure of that. They made it hollow on the top so that the screw or the bolt will be lighter, and a lighter bolt will have less cost, right? Because you're buying them by the kilogram or by the quintals or tons, so you have less weight and the cost is lesser. So maybe that will reduce the cost of the car by like 0.2%, but still they are worried about it, and they still try to act on it and reduce that cost. So that's the level companies will go to. And we all know that manufacturing companies and service businesses ask everyone to do overtime. So can you do overtime? Can you do overtime on 1.5 times the pay instead of 2.5 times? So these are things that they are using. Sorry. Okay, so these are things they're using to reduce their production cost, and that's the control department. So we see now that there are different departments inside a company trying to control their cost and bring down the cost of a product, and thereby reduce the cost for the whole company. Then there is also a quality control department that is not discussed very much here, but a quality control department can also be very important. So let's say your service business is the LRT train. So let's say it's a private company that operates LRT trains inside a city. Now LRT trains are designed to take up a number of passengers. There's a limit to the amount of weight they can carry, and the more people it can carry, the lesser is the cost for that LRT system or the management company. Now if you look at in Canada, it's not very rushed, but I think some of you might have seen videos of India. In India, they have LRT trains and people are hanging outside it. People are hanging on the windows, on the doors, and you can just imagine how many people are standing inside the train. So how does the train still function? That all depends again on the quality control department. They have to design a train in such a way that even though the box says outside that it is meant for 72 people, so if you go to India and look at a train, the box will say 72 people in this box. But in actuality, I have lived in that city and there are 300 people inside that box. So where the capacity prescribed is 72, there are at a time 300 people sitting inside there. So is it good for the company? It's great for the company actually. The cost of operation, if there were only 72 people inside the cab, would be very high. Since there are 300 people sitting in there, the cost for the companies become really low and they can operate the train at a very cheaper price. And that's exactly what they do or plan to do. Okay, so that's the quality control department. Now, defining management accounting. Management accounting is the application of professional knowledge and skill in preparation of accounting information in such a way as to assist the management in formulation of policy and in planning and control of operations of the undertaking. So we are going to learn the application of professional knowledge and skill in preparation of accounting information. So what we are going to do basically is accounting, but it's not the same structure that we used before. So accounting, as we discussed during financial accounting, is you record transactions and you report them. In management accounting also, we record them and we report them. What is the only difference is we are not recording only money. We are recording money, we are recording units, we are recording number of people working there, and we are recording the resources that are engaged in the business. So we use that and present that information to the management. We don't present this information to the government, to the shareholders, to anyone else. The information is only presented to the management of the company. So the management can use that to create policies and do their planning and control of operations of the undertaking. So relationship with financial accounting for management accounting. Oh, my font is really unclear here. Okay, I'll read it for you. The red box on the left side below the title relationship with financial accounting, it says management accounting is differentiated from financial accounting for the following reasons. Okay, so these are the reasons why management accounting is different from financial accounting. So number one reason, user orientation. So management accounting provides information to internal management. Okay, so information here is about management accounting. User orientation here is internal management. Financial accounting information is available to everyone, like the financial statements of a publicly limited company that is listed on the stock market. That financial information is available to everyone. If you want to download it, you can download. The government can see it. They have to file that taxes with the financial information, so obviously they have to give it to the government, right? So everyone has the information. But for management accounting, the thing inside the company is this information is only with the management, and it is important to keep it secret inside the company or only with the management so that other companies or your competitors cannot see that. If your competitors can see that your production cost is higher or lower than them, then they can do something about it and beat you in the competition. So companies want to hide that information. That's why management accounting information is internal to the company, not released to anyone outside. And it is not even required to be released. The government has no law that says that you have to release the management accounting information. Then the focus on particular division, department, and products. Now, whereas financial accounting will focus on the whole company. Let's say if we take the financial accounting of any business and they have 3 or 4 shops. Let's say there's a business who is doing financial accounting with 4 shops inside a city. So they will have to prepare one financial statement if they are established as one company. Okay, so let's say example Pizza 73. Okay, there's a pizza chain we know about, Pizza 73. Okay, so let's say Pizza 73 are all operated by the same company. So the company that operates Pizza 73 will file one financial accounting information. They will have one annual financial statement that will have the revenue for all Pizza 73 inside the city, salaries for all of them, wages, utility expenses, rent for all of them combined. But inside management accounting, what happens is you have differences. Each unit of the company will have a separate report. So the management can know which Pizza 73 is performing well and which one is not. In financial accounting, we don't have that information. We have just the whole company's data. In management accounting, we have every unit. So if a company has different manufacturing plants, let's say like Ford, the automaker, they have different manufacturing plants. They have one in Canada, one in US, one in Germany, one in India, one in China, every place. So they can, when Ford files their financial information, like the annual report for Ford will have combined information for all these plants. But when you look at the management information, that will be separately created for the plant in Canada and separately for the plant in Germany. Everyone will have a separate report. And also inside the plant, let's say Ford in Canada manufactures the pickup trucks, the sedans, and the SUVs. So the SUV department for Ford Explorer, Ford Expedition, Ford Escape, Ford EcoSport, they can have a different report, whereas the department for Ford F-150 can have a different report. The sedan department for Ford Taurus, then the Ford Fusion and Focus, they can have a different report. That can again be subdivided into divisions. For example, Ford Explorer can have a different report about only for the management as to how the production for the Ford Explorer brand is going. Okay, so that's again a subdivision for management accounting, and they will have a separate report for that product. Again, in that product, there can again be a subdivision as to how the all-wheel drive brand is doing and how the other brands are doing, how the premium range of Ford Explorer is doing, whereas how the basic model is doing, what the cost and profit are there. So these are all subdivisions. So in management accounting, you can focus on one part of the business, whereas financial accounting will just focus on the complete business. Then there is the time dimension, provides data for present and future needs. So the other thing about time is also that you don't have to create the financial statement after 1 year. In management accounting, you can create a statement after 1 month if you want, if the management, or even after a week if the management wants it. The financial statements that we prepare for tax purposes, or they are year-end financial statements, right? So they are basically created for tax purposes, and people can see it. We do not create a balance sheet for 6 months or an income statement for 3 months for a company. We create it for the whole year. So it provides data for present and future needs. So it is actually created for future needs. It reports what's happening today, and then the company can decide what they want to do in the future. For example, the management accounting department for Canadian Tire can have reports. They can have a summer report and a winter report. So the summer report will state that, okay, this is the summer season. We ended it on August 30th, and this is the stock that is still lying with us. So the report will mention that it's product with number so and so. That will be like 052770. That's how Canadian Tire have the product codes over every product, right? So that will give a list of products that these are the products we were not able to sell during summer, and some stock is still left with us. They are definitely not going to be sold for winter. They are not products that are bought in the winter. They are just summer products. So so what can be example of that is bought only in summer and not in winter? Like, let's say sunscreen. They don't sell sunscreen, no. So let's say there are some product for winter. Okay, they have clothing for winter, or they have winter tires. So so let's take the example of winter tires. The report for management accounting from the cost department will mention that, okay, we have winter tires worth $100,000 in stock. They are definitely not going to sell during this summer. Okay, so the report may be prepared in, let's say, March. So what to do with these products? Then the department will decide, okay, we'll have to store them for the next 6 months and sell them during the next winter. Now storage will have their own cost, so they will have to add that to the report. So the report is not becoming for the present. The report is also becoming something for the future. Okay, so the report is including that today we have this many tires with us. This is the price of those tires, and this is the cost of that stock. If we sell them at so and so price, we are making a good amount of profit. Whereas if we have to store them for the next 6 months, we will have to pay warehouse cost, we'll have to pay insurance cost on the stock and various other things. So our cost will go high. So the management accounting department then has to make a decision. Do we create a sale for these tires? Do we unload them from our stock into the market at a discount, or do we hold them for the next 6 months? So the management accounting department then has to make a report that, okay, storing it for the next 6 months will have so and so storage costs, then there will be insurance cost, and then there will be so many employees required to move them and store them. So let's say that takes the price from $100,000 to $106,000. Okay, so the management now knows the stock that is not sold is going to cost them $6,000 more during the next winter. Now let's say they realize that, okay, the product has a profit margin of only $5,000. So the situation is you have $100,000 of product now. If you sell them right now, they will sell for $105,000. If you sell them after 6 months, they will still sell for $105,000, but you will have a storage and insurance cost for the next 6 months. That will be $6,000. So you are making a loss of $1,000. So then the company decides, okay, instead of selling it for 105,000, which it will not sell now because summer is already here, let's sell the product for $102,000. Okay, so they will create a clearance sale on Canadian Tire app, and the flyer that you receive at your home will have a clearance sale from Canadian Tire that says that tires are now available at a 3% discount or maybe 5% discount. So what the company is doing is this: they are trying to unload their product because they don't want to store it for one more summer and pay the storage and insurance costs. So instead of making a loss of $1,000, if they store it for the summer, they are making a profit of $2,000 now. So they are definitely not making the $5,000 profit that they were supposed to make. They are making $2,000. But the other option they have available to them is that suffer a loss of $1,000. Okay, so does everybody understand that? I can show that on a Excel sheet if you want. Okay, so let's say there are products. Sales price. Okay, if you sell them at the selling price, they will be sold for $100,000. Storage cost is $4,000. Insurance cost is $2,000. Sorry, this is $105,000. Cost is $100,000. So this is the situation you have. If you store the product, you are paying $6,000 extra. And because this is $105,000 at selling price, then you will have a loss of $1,000, right? In this situation, but you decide to make a sale. So what you do is you take this same product and you decide to sell it for $102,000. So then in this situation, instead of making a loss of 1,000, you make a profit of 2,000. That's what the company decided. Instead of selling it for $105,000 and then paying $6,000 for storage, they decided to sell it for $102,000 and take their $2,000 profit. So this is where management accounting department comes in to make decisions. Then there is the measurement criteria. considers monetary as well as non-monetary events. So management accounting can record money events, money related things, and it can also record non-monetary transaction. That is something that is not related to money. Then frequency of reporting can furnish information quickly at short intervals. So management accounting can furnish information at any frequency of reporting. If the management requires a weekly report, the production department can definitely have a weekly report. If the production inside the company is running 24 hours, they can have reporting every shift or maybe every day. So let's say there is a beer manufacturing company. Now, beer manufacturing normally is a 24-hour process, because at any given point of time, the production is never stopped. Even if somebody is not working inside the company, even if the plant is closed and locked outside, there is fermentation still going on inside the company. Inside the big vessels, the barley and the beer raw material is still being fermented, that will be used in production later on. So beer is an example where production never stops. So 24/7 the production is going on. And there are also companies where literally production is not stopping. That is, people are working in the night and the day. People are working there in the night shift and in the day shift. Like if you look at the Amazon warehouses, like Amazon warehouses where they pack and parcel the products to the destination, or pack, unload them for delivery inside the city. That is a 24/7 running operation. So it never stops. Those things, or like the Amazon warehouse, can have a daily report of operation. Like the manager of that site can see a daily report from the accounting department as to what the cost was today. Whereas financial information, we know it's only reported after 1 year. Then precision. Precision means emphasis more on timely provision than precision. Okay, so here what happens is the report may not always be precise. So what happens is you may create a report in the duration of 1 day, but some things may change the next day. So some things that may not have been recorded will come to light the next day. So the reports are not very precise. Like let's say you make a weekly report about the warehouse. Let's say the Amazon warehouse makes a weekly report of their operations. The report is then presented and decisions are made. However, after 2 or 3 days, they realize that, oh, we did not calculate the cost of new recruits. So in the last week, we hired 20 new people and they were trained. So and so is the cost of their training. That is not recorded. Let's record it now. So then that becomes a very, not very, but a little bit imprecise report. But the emphasis in management accounting is to have a report at shorter interval. They want a report every day or every week. So the emphasis is not more on the report being a precise and accurate, but it's more on the report being available quickly to them. Legal requirements. It is not legally mandatory to give this information. Okay, so legally, you don't have to disclose your management accounting information to anyone. It is just for the management inside the company. Okay, at this time, let's take our break. Let's come back at 10:15 and we'll continue with the chapter. Okay, now everyone's back.
Yes.
Right.
So continuing further with the differences between management accounting and financial accounting. So the next one is impact aspect. So management accounting is concerned with the impact and effect of cost. Okay. So the basic purpose of management accounting is to reveal how much profit you are making and how much money was spent in making your product or service. So cost is our main concern in this case. Whereas in financial accounting, we don't have a concern for anything. Financial accounting is just a report we prepare, and whatever happened, we just truly report it. And this is what happened inside the company. Whereas in cost accounting, there is a purpose for your accounting to reduce the cost. Where it go? Okay. So impact is, so we are concerned with the impact and effect of costs in a company. Then data. For management accounting, the data is derived from cost accounting. So data is actually derived from financial accounting and other sources in the company. So not only the accounting department of the company, but other departments like the human resources department, the production department, then the quality control department, all will have data contributing to the management accounting data. Because since we said we are not recording only money related transaction, we are recording everything about the company to find out how the performance is. So something we do in cost accounting is also cost per unit. So once you calculate the production cost for a month, you can assign it to one unit, and that will tell you that per unit what was your cost of production. And it will also give you information as to per person what was your return. So let's say you made a production of 3,000 units and there were 50 people working in the company. So you know from that report that every person that was involved was creating like 60 products in a month. 50 times 60, you got 3,000. Then it can also be used to create to reduce or increase the number of employees. Just like we studied in economics, the marginal returns that can be used in cost accounting, whether you want to increase the number of people working in the company, whether that will lead to an increase in your production or it will not lead to an increase. So that data can also be used. Then there is perspective. Data is given greater relevance and objectivity. So since a large amount of data is used, and not just the monetary, but the non-monetary data is also used in this practice, the data is given a greater relevance and objectivity for its use. Relevance being that some information that is not used in financial accounting becomes more relevant in cost accounting because it is not available at another location. Okay, so since you cannot get information about what is the per unit cost or what is the unit production, how many units were produced or how many people are working, what is the performance of per person in the company, or per laborer, how much production is made. Since that data is only available in management accounting and not available in financial accounting. A hierarchy, it is placed at higher level of hierarchy. A hierarchy here meaning the hierarchy of the company. So who uses management accounting data is normally the higher level management of a company. The people who are going to make decisions about what happens inside a company, like what the production department will do, how many people they will hire, what kind of production line they are going to use, how much time a product has to spend on the production line before it is ready, and how many units are to be produced. So that depends. That is why management accounting data is more relevant to the higher level of management where decisions are made. Then there is a wider approach. Applies cost data to economic and statistical data. So economic and statistical data, like we saw the chapter in economics where we calculate marginal output of labor. So marginal output of labor tells us that if you keep adding another person to the production department, how much your production will change. So we saw that curve, right? When you start the production becomes faster and faster with every person you keep adding to your labor force. But after a while, when you start adding people, the production doesn't increase at that rate. So there is a loss, or there is a diminishing marginal return, as we saw in economics. So the same data is used in cost accounting. Since cost accounting is looking at the cost, they know that adding extra labor is not going to reduce our cost at this stage. So that information becomes important for cost accounting. So here we have a data coming in from economics that is used in cost accounting data. Okay, so like increasing marginal returns, diminishing marginal returns, or negative marginal returns. So cost department at all costs, they want to avoid diminishing marginal returns. Diminishing marginal return means that your number of labors are increasing, but your production is going down. So your cost is increasing. That the only effect you're having is higher cost, nothing other than that. So economic and statistical data is used. Statistical data is like, the measures of central tendency, measures of variance, measures of, sorry, not measures, but correlation and regression. Those things may also be used by management accounting data to make a better analysis. So we have data coming in from other fields that is used in cost accounting. Then there is the scope. Uses cost as well as financial accounting data. So since financial accounting data is limited to money, that is it has a limited scope. Okay, so financial accounting data is dependent only on monetary information, whereas for cost accounting data we have monetary and non-monetary information. So the scope for this kind of accounting becomes larger than financial accounting. Then the assistance and evaluation. It assists functions of management and evaluates performance. So with cost accounting, you can evaluate the performance and assist in improving it. Because once you know the cost, once you have a monetary information that this is what my cost is, measures can be taken to control it. So what happens in management is something that cannot be quantified becomes really difficult to control. Okay, something that you cannot uh, report in the form of a number is difficult to control. So management accounting tries to put everything in a number. The number is cost. So as we discussed the example of, let's say, a production department that has a cost of 88%. Just give me a second. Okay, so that was a call from the college. So Nike Joy and Alice, you're still in class, right? Nike Joy. Nike Joy and Alice, why you're drawing on the screen?
Yes, sir. Because I'm using my phone and
Oh, okay.
yeah.
I got a call from the college. They are asking if somebody is done with the course. So you're done with this course, right? Management accounting.
Yes, yes, sir.
So you should make a call. Actually, I think Mr. Laskar will look at that. Mohammed Laskar.
Yes, sir.
Assign you.
Okay.
I don't think.
Okay.
Okay.
So I just wait the email.
Did you send the email to him?
No,
No, then you should send them an email because then one day will be wasted, right? They can transfer you to another class.
we're in the Monday.
No, to Laskar, Mr. Laskar.
I
Let me
don't
check the
have
email
a
ID.
email for him, sir, or for the teacher.
Okay, I'll send you the email ID. Wait.
Okay, sir. Thank you. Yeah, thank you, sir. I got it.
Okay.
So I will leave here now.
No, yeah, just send them an email and talk to them
Okay.
what class they transfer you into.
Okay.
All right. Okay, so moving on. So we were looking at assistance and evaluation. And I was talking about if you can quantify something, then it becomes easier to control. Okay. Wait, that's done. So, okay, nothing, just the typical first day of our class. and some things to do. Okay. So we were at assistance and evaluation, and I was reporting, I was saying that everything that can be quantified becomes easier to control. So cost accounting does the same thing. So we look at we discuss the example where let's say some company is having a cost of 88% and then they decide to reduce it to 85%. So you have a quantity here. You have a number that this thing has to change from 88 to 85. So the management department can do many things about it to reduce the cost. They can change the raw materials that they use. They can reduce the number of people that are used. They can use more automation, or maybe they can use a different process to bring the cost down. The thing is, you know where you stand, it becomes easier to improve. Right? Just like somebody's exam score. If they know the score is low, they have the number for that score, and then they can study to improve their score in the future. Same thing with management. Once you know the number, you can improve it in the future. Then the next point is of dependence. So management accounting is dependent on cost accounting for data and application. So here what they're saying about difference between cost and management accounting is management accounting has further stages after cost accounting. Cost accounting only tells you that given one process, for the particular process that you follow, these are the costs that you have. Management accounting can go further after that to show you what the variance in cost is, what your marginal costs are, and what the budget for that cost is. So that can involve like further sections of our syllabus that have like budgeting, standard variance, cost and volume profit analysis. So many more things in management accounting. But it starts with cost accounting data that this is what you sold the product for, and this is what it cost you to manufacture it. Okay. Then why is there a need for management accounting? It provides timely and relevant information, which is the most important aspect of management accounting. You can have a management accounting report anytime you want from the company. Nowadays, companies have software that can give you a report instantly. Mostly companies have an enterprise resource planning software, or what's called a ERP software. Mostly SAP. SAP is a software used by many manufacturing companies to manage the whole operation. And SAP can give you a report of any department at any time. So it provides timely and relevant information, serves as a management information system. So cost accounting is a management information system. Information system meaning again connected to the info IT system in a company. Management reports can be available at any time. So information system being, if you are a manager inside a company, let's say a accountant or a manager, you can anytime pull out a report about the company regarding their production department. They are available instantaneously due to technology. They were not so like a long time ago, but due to technology now they are available anytime. And being an information system, everybody inside the company is getting the same information. So the CEO and the production supervisor have the same information about the company, which makes it easier for them to cooperate with each other. Okay. Then management accounting for planning. For planning meaning, if you know what your situation today is. So let's say you know that your production cost today is 88% of your selling price, and the company demands to reduce it to 85%, then you have a plan. You can produce a plan that will take this cost down from 88% to 85%. So if you want to make a plan, you should know where you stand today and what is expected out of you. So planning is always dependent on those two things: where I stand today and what is expected, what is the expected outcome from you. That will lead you to creating a plan. So management accounting for control. Control meaning also that once you know where you stand today, or once you have a quantity or a number as to what your performance is, you can change that number in the future to have a better performance. So just like planning, you should know where you are. To even control, you should know where you are. Planning is for the future as to what you're going to do in the future. Controlling is what you're going to do now or what you need to do now. Then management accounting has a more proactive approach. Proactive approach meaning it is looking in the past, what happened, and it is also planning for the future, what has to be done while staying in the present. So you get data from the past, you make a decision today about what to do in the future. So that is a proactive approach. Financial accounting is mostly retrospective. It is called retrospective, meaning it's looking at what happened in the past. We don't discuss about what's going to happen in the future. We just record what happened and report what happened. So it becomes a more retrospective approach rather than a proactive approach. Then there is inflation accounting. Inflation accounting is not very relevant at this stage, but some companies do inflation accounting too. So let's say they are saying that the cost today is 88%, and we expect that in the future, the cost of raw material will go up by 5%. So that is inflation accounting. So you know that the cost of your process or the cost of production for you is going to increase in the future further on, because raw material is expected to get expensive. So just like let's say for example, some company that creates electrical wiring system. So electrical wiring system has the wires that we use inside our house, and they have an inner core of copper. So the main production input for those companies are copper and plastic to insulate the system. So the company knows if the prices of copper in the international market change, the production cost for this company is going to change. So they have to pay special attention to inflation accounting as to what the price of my input is going to be. Similarly, if like the government has a new regulation that increases the minimum pay. So let's say the minimum pay is in Alberta right now is $15. So British Columbia just increased it to $15.10, I believe. So if the Alberta government also decides to increase it to, let's say, 15.50, that is again inflation accounting. And inflation accounting, and the company will have to take that into account too, that my raw material cost can change, my labor cost can also change. Then the power cost can also change. During winter, it's the power cost normally go up for a company. During summer, they are lower because cooling system, heating system are not running on full power. So inflation accounting is accounting for how prices can change in the market, and that can affect your production cost. So what is a management accountant? So most of the times you won't find a position specifically in the company that says management accountant. So technically there are no management accountants. There are just accountants and managers. Everybody inside the company who is in a management position has to learn about management accounting. So if you're in a managerial position, you should know what budgeting is, what the variance of cost is, how the cost accounting data works. Everything should be understood by you. So as a management accountant, your role will be budgeting. Budgeting is preparing for the future. So once you have the cost data for the past, you can prepare information for the future as to how you're going to handle it. So in this case, companies use something called a scenario analysis. Scenario analysis for budgeting is like they will create scenarios as to what can happen in the future and then create multiple plans. So the planning will be like that. Let's say there are 4 situations. First situation, the price of your raw material and labor can increase. Okay, so that's the first situation. Second situation is the price for only raw material will increase. Third situation is only the price for labor will increase. And the fourth situation says that your sales can drop, or the sales or revenue for the company can reduce, or the consumption will not be the same as it was. So the management has multiple situations that can happen. They assume that prices can go up, or they assume that sales can go down. So those are negative analysis. Then there can be a positive scenario also, that the prices can go up for the sales too. The prices of your product that you manufacture, they can increase, or the prices of your raw material can decrease in the future. So that will make it better for the company to manufacture the products. So that is budgeting. Budgeting is creating scenarios about the future and then planning ahead that what you want to do. So just like you have a budget for your monthly expenses at home, the same is what companies will do. You know that my monthly income or my bi-weekly paycheck is so and so. Anything, let's say, right? Like 1,000 to $2,000 in between. Mostly it varies, right? So you know that your bi-weekly check will be, let's say, 15 to 1,600, and you know what your expenses are, your what your monthly rent is, what your grocery expenses are, what your cost for your vehicle and other things are. So you already have accounted for those things. So that is your budget. Your expenses depend on how much money you make. So same is for companies. Their expenses or cost depend on how much they sell product for, or how much their raw material costs. So the first job of management accountant will be budgeting. Second will be handling taxes. Now taxes is majorly a domain of financial accounting. But since tax is money, you're spending money or you're giving money to the government, that becomes a cost for the company. So no matter how much money you make, you have to pay a tax. And let's say the tax is 30% of profit. So what happens now is your cost that was at 88% giving you a 12% profit, right? So $100 is what you sell for. 88% meaning that $88 is your cost behind every $100. And now you have to pay taxes. So that means out of the $12 of profit that you made, you will have to pay $4 as taxes. So that becomes an additional cost for your company. So the management accountant has to handle those costs in the form of taxes. Financial accountants can manage taxes, but management accountants don't have that much power in managing taxes. Because financial accounting, we know the laws. We know that there are some expenses that you can incur, and the profit can be reported as a lower profit. So let's say let's say your company is reporting a profit of $1 million. Okay, so in that scenario, you have to pay a tax on $1 million, which at 30% would be like $300,000. One thing financial accountants can do is there is something called depreciation in our income statement, right? Now, depreciation is an expense. We treat that as an expense, but technically, you're not spending any money from your pocket, right? You don't spend any money from your pocket or from the company, but you still have a cost there. So the more you increase this cost, the lesser your profit will be, and you don't even have to spend any money. So many companies, what they will do is they will report a higher depreciation so that the profit appears to be smaller on the books, even though it's larger. So that is management of taxes. However, that is majorly done by financial accountants, not by cost accountants. Then there is a managing assets to help determine compensation and benefit packages. So many times the remuneration for production supervisors are attached to the production targets. So let's say the example of brewery again. So a company that manufactures beer. So a beer manufacturing company has targets. Let's say they have a lot of sales and they have 2 assembly lines working on full capacity. So what the production supervisor can do is they can work the production line beyond 100% capacity. So let's say they have a mixer or a fermentation tank, and the fermentation tank says that the capacity is 1,000 liters. So it says on the tank that the capacity is 1,000 liters, but many times the production supervisors, they know that a 1,000 liter capacity tank can handle up to 1,200 to 1,300 liters. So they will fill purposefully 1200 to 1300 liters of mixture inside a 1000 liter tank. The tanks are bigger, they can handle that, but it's just that it is prescribed to keep them at 1000. But the production department supervisors will still take it to 1200 on 1300. They know nothing happens major to the machine. Maybe you will have maintenance issues after 1 or 2 years, but today you don't have any issues. So they will run the machine at 20% over the capacity and increase the production. Why do they do that? Because many times production companies have compensation and benefit packages for the production supervisor depending on how much more production they can do at lower cost. So by using a machine at 120% capacity, they are reducing the cost and increasing the production. So at the end of the month, the production supervisor can report that I did 15% more production this month than last month, and I reduced the cost of production by let's say 5 or 7%. So since he increased or made more production, and since he decreased the cost of production, the production supervisor will then be given promotion or benefits or sorry, like bonuses for that or reward for that additional production, even though he is using the machinery at a higher capacity. So, but that is something attached to cost management. If you want to reduce the cost in a company, you have to give rewards and benefits to the production department so they can work more and decrease the cost for your company. And similarly, as you understand, I told you the example of the LRT trains in India. The capacity is 72. But even if 300 people sit in there, the train is still easily running with that capacity also. And that in turn reduce the costs on the LRT system in the city. So if they have to run this train on 72 to accommodate 300 people, they will need to run 4 trains. Instead of 1 train, they will need 4 trains, and that will be a very big cost for them. So if 1 train can do the job of 4, they don't need more for the LRT system. So managing assets to determine compensation and benefit packages under cost accounting. That's how it is done. And then aiding in strategic planning. Strategic planning, as I told you, is about very long-term plans, not just long-term plans, but very long-term plans to do with the next 5 years to 25 years is called strategic planning. So what happens is one of the production cost is rent. Okay, as we looked in financial statements also, one of the costs that companies incur is rent. Now, how it happens in accounting is rent is not charged only when the company has a rented building. So let's say some company has an office in the downtown that is rented. Then the company has a rental cost. But what happens in management accounting is even if you own the office, even if you are owner of that building or you own the place, cost accounting and management accounting will still charge a rent, as if the situation was you had taken the building on a rent. Now, since you have paid the price for the building, you already own that, you don't have a cost. But production department will still treat that as a cost because you don't want your asset to be idle, right? So what happens is the production department will consider that, let's say you did not own this building, you had rented it out. What the cost is going to be in that situation, they will assign it to the planning, assign it to the asset anyway. So that's the reason why many companies decide to move outside the city. So if a company does not have any issue with what kind of property they have, they can start production outside the city. Just like I gave you example of the Costco store outside Calgary. So this is a Costco center, big store that is located outside the city, around 3 kilometers outside the ring road. Okay, so why is it located there? Now, Costco is a chain of superstores that tries to sell their products at a lower cost. So obviously, if you want to sell them at a lower cost, you need cheaper property. So Costco will buy cheap property places where they can reduce their rent and then sell product for a cheaper cost. Now, if Costco had to buy a property inside the city, they will have to pay a bigger price to buy it. they will have to pay a lot of rent if they lease it out. They will have to pay a large amount of property tax to the government to manage that property. All those money is going to come from the profit of the company. And if that's the situation, then Costco will have to increase the prices of their product. So in order to keep the prices low, they will always open their store at properties that are away from general population. There are some stores in the city, but they must be really old. So generally new stores, they will open outside the city. So the property costs are low and they can sell their product for a lower price. And that again is part of their strategic planning. Then there is capital budgeting. Capital budgeting means how you want to arrange your capital. That's also a part of your cost. So one is rent. The place where you take your property affects your cost. If your property is outside the city, your property cost will be low. If your property is inside the city, your property cost will be high. Same is with capital budgeting. Capital budgeting relates to how you arrange your capital or where you're getting the money from. If you're getting a loan from the bank, you have to pay interest on that. If you take debentures or issue bonds in the market, you again have to pay a interest on that. So that becomes costly for the company. Whereas if you issue equity shares do not carry any interest. So the company does not have to pay anything. So that again becomes a cost department issue. How should we arrange money for our production? Should we hire should we take money as a loan and then pay interest on it, or should we issue shares for the company and pay no interest for that? That is the capital budgeting decision for cost accounting. Then there is ROI techniques. ROI is return on investment. So cost accounting will tell you that you sold a t-shirt for $25 and the production cost for this t-shirt was $18. Okay, so producing a t-shirt for $18 and selling it for $25 is a profitable deal. But businesses are more concerned about what the return on investment is. So they will tell you that the monthly cost for this business is $50,000 to operate the business. That is the rent for the building, the salaries of the employees, and the taxes. They add up to 50,000. So the cost department then knows how many t-shirts they have to produce and sell so that the cost of $50,000 is justified, right? Like you're making $7 with one t-shirt, 25 minus 18, you're making $7 per t-shirt, right? So you will have to sell around 7,000 t-shirts just to cover the cost of that business. When you're making more than 7,000 t-shirts, your business starts to make profit. So that is where ROI techniques become important. Looking at one t-shirt, obviously you're making $7 when you sell one t-shirt. But because the cost of business is $50,000 a month, you know that you have to produce $7,000, 7,000 t-shirts every month just to cover the cost of business. So if you produce more than 7,000, only then the business will have a profit. So ROI techniques focus on how much profit the business is producing rather than how much profit you're making on one product or one unit of your product. So that was all for introduction of management accounting. So I hope by now you understand there is a big difference in financial accounting and management accounting. Or you have some idea that management accounting is something that is going on inside the company. People outside do not necessarily know about it, but those things are still going on. So then we have cost accounting. So this is going to be our first numerical problem solving chapter for cost accounting. So as I told you about cost accounting, we have three kinds of companies that operate in the market. There are production-based companies that have a manufacturing department that produces on an assembly line continuously. There is production going on. Then there are contractual companies. Contractual companies make one thing at a time and sell it, like house construction companies, or then there are shipyards, companies that build ships, like container ships that carry containers on the sea. They are built as by something similar to a construction companies. And then there are companies that build aeroplanes. They also work on a contractual basis. So ships are manufactured by companies like, the car company Hyundai, the South Korean company that makes cars for Hyundai. That's the same company that makes container ships too. The large transport vessels that roam around on the sea, they are also manufactured by Hyundai. So what is cost accounting? Cost accounting involves the techniques and processes for measuring, recording, and reporting the cost associated with a product or service. So, do you guys want to learn this today or tomorrow? Because we have enough time to do it anyway.
Sir, all the slides is in Brightspace.
No, I'll add them. I will have to add them. Yeah, over in Brightspace, you have some slides, but they are very detailed, and some of the things over there are unnecessary. So what I'll do is I'll create a new chapter on Brightspace module. Let's call it the classwork module.
Okay, thank you.
Yeah, so there will be a module or a chapter on Brightspace called classwork, and I will put everything inside there. Some of the files may change, but as they change, I will update the files too. So there are going to be like 4 or maybe 5 types of problems and solutions that we're going to solve in this chapter. They are not very difficult, easy, and we will not keep them at a high difficulty level. We will keep them at a manageable difficulty level. Okay. So the 3 important slides I have added here. So the content that the college already has does have some problems and solutions inside it. And we will refer to them, but we'll come back to these 3 again and again. Okay, so the 3 slides that you will see in the classwork module will be the major part of our syllabus. Mostly that is what we're going to do. There may be some things added that we'll add them over time. So anybody has any question about today's slides? That is an introduction to management accounting. Okay, majorly nothing to do with financial accounting. We don't have any journal entries. We don't have a ledger posting. We straight away go to something similar to the income statement. So if you remember the income statement from financial accounting, doing cost accounting should be very easy for you in that case. So today what I will recommend to you is you should go through the income statement again, the financial statements that we solved. Let me bring that up. So the financial statements that we solved, if you remember this part, the income statement of a financial statement, of the financial statements, then I would say like almost 50% of your cost accounting will be the same thing. Okay, so there is not many major differences. There are some differences, but I would say like 50% of your cost accounting will go really easy if you are well understood with this statement. Income statement for the financial statements, financial statements. Because cost accounting is the same thing. You have your income here, that is your sales, and you have your expenses here. That is the same way a cost statement is made. You reduce the income from your the expenses from your income, and you're left with a profit. The only difference is here I will state a percentage, or you will have to write something like cost per unit or percentage cost. That's the only added statement. Otherwise, remain similar to it. You will have different sections, but they are similar. So if you want to revise today or study anything, I would say go through the income statement again, and then we'll come back tomorrow to start with cost accounting and the problems in that chapter. Okay, so if you want, you can stay in class, review the income statement, have any questions about it, ask me. If you have anything important to do, you can go ahead and do that. I have to finish the attendance, right? Yeah, I didn't finish the attendance yet. So, attendance. So Rachel Laraya won't be in this class. Abdul Latif is here. Grace is here. Arnold is here. Asifa is here. Asifa, you will need your computer. You are on your iPhone. Did your computer break down, or is there a problem?
I don't know. There is something wrong with Google Chrome. Every time I logged in, the cursor is going and it doesn't open the Zoom page. I don't know. There is something wrong.
Yeah, but because for this module you will need a screen, right? We have to solve the problems on screen. So I don't know if on the phone you can see everything.
Okay, I'll try to fix it.
Yeah.
Okay.
Yeah, from tomorrow we are going to solve them on Excel, either on Excel or some other place, but you will need a computer to look at it, right?
No, the computer is working. My problem is on Zoom.
Oh, only Zoom is not working.
Yeah, only Zoom.
Maybe you can download the app for Zoom. They also have an app, right? Like on the
Okay.
computer, you can have a software. Are you like logging in through the website for Zoom?
No, I'm using Zoom on the Chrome. I Google Zoom, then.
Oh, okay. Yeah, you can also download Zoom on your computer.
Okay. All right.
Yeah.
I'll try that.
You try that. Yeah.
Thank you.
Okay. Yeah, anyone else, if you're on the cell phone, you'll have to get on a computer, okay? Because you need a screen to look at it. Francis is here, okay. Jude today. Judith. Michelle Akane. Michelle. No. Okay. Maylene is here. Raylene. Rayline. Rayline Guzman. No. Okay then. Yeah, I've recorded the attendance and we are done for today. If you guys have any question, you can ask, and you can revise the income statement from financial statements or financial accounting 1. Then we can start with cost accounting.
Okay, sir. Thank you. See you tomorrow.
Okay.
All right. See you tomorrow, everybody.
Okay, bye.
Bye.
Bye, guys. See you tomorrow.
Bye, sir.
Bye.
Thank you, sir.
Okay, bye.
Sir,
Yes.
yeah, this is Janea. So do I have to contact Mr. Lasker as well regarding the transfer?
Yes. Yes, you'll have to talk to him. So he's handling the class assignments, and yeah, he will assign you to whatever class is best.
Okay. Do you think he will allow like attending classes simultaneously? Because I still have 2 weeks with Miss Ara for my economics module. Yeah.
Oh, yeah, I think he would know best. Like the economics module is in the evening, right? That's the evening batch.
Yeah.
So I'm not sure how they make the decision on that, but
Mm-hmm.
maybe, yeah, maybe they will allow.
Okay. Yeah, because I checked and I think we basically took the same modules already, except for we took business math already and